We're breaking down index funds for beginners. And trust me, this is one investing tool you need to understand. Whether you're just starting out or you've been in the market for a while, knowing how index funds work can help you invest smarter with less stress and less guesswork. Index funds are one of the simplest, most effective ways to grow your money. They're used by everyday investors and billionaires alike, and for good reason. Today, I'm going to walk you through what an index fund is, how it works, the pros and cons, how to invest, and how you can start building wealth, even if you've only got $10 to your name. This is investing made simple, so let's get right into it. First, let's break down what an index actually is and why index funds have become one of the smartest ways to invest in the stock market. Part 2, what is an index? What is an index fund? So let's start with the basics. What exactly is an index? An index is just a group of investments, usually stocks or bonds, that are bundled together to represent a portion of the market. One of the most famous ones? The S&P 500. That's a list of the 500 largest publicly traded companies in the United States. We're talking about companies like Apple, Microsoft, Amazon, the heavy hitters. But here's the thing. You can't invest in the S&P 500 directly. It's just a list. But what you can do is invest in an index fund, and that's where the real magic starts. An index fund is a type of mutual fund, or ETF, that's built to copy the performance of an index. That means it buys the same stocks that are in the index, often in the same proportions. So if the S&P 500 has 6% in Apple, the index fund will too. Let's make it super simple. If the S&P 500 goes up 1%, then your S&P 500 index fund will go up about 1%. If the S&P 500 goes down 1%, then your fund will go down about 1% too. That's the beauty and the limitation of index funds. With an index fund, you're not trying to pick winning stocks and outperform the benchmark. Instead, you're tracking the benchmark itself and accepting its average returns. You're not trying to beat the market, you're trying to beat the market. 3, how index funds work. So how do index funds actually work? Let's take an example. If you invest in a fund that tracks the S&P 500, that fund will own shares in the 500 largest publicly traded companies in the US, from Apple to Amazon to Walmart to Google. Now, here's what's cool. You don't have to research 500 companies or rebalance your portfolio every week. The fund managers handle that for you. They only make changes when the index itself changes, like when one company gets removed and another one gets added. And because index funds buy and hold the basket of companies, they don't trade often. That means fewer costs and less stress for you. You're basically buying a slice of the entire market. Instead of betting on just one stock like Tesla or Microsoft, you're holding hundreds, maybe even thousands of companies all at once. That's called diversification, and it's one of the biggest advantages of index funds. You don't need to guess the next big stock. You already own them all. So now that you know how index funds work, let's talk about why so many investors, beginners and pros, are turning to them. Because when you look at the bigger picture, the benefits are hard to ignore. Part 4, pros of index funds. Let's talk about the good stuff. The reasons why so many investors, beginners and pros alike, love index funds. First, they're passive and hands-off. You don't need to be glued to the stock market. You don't have to read earnings reports or keep up with what the Fed is doing. You don't need to stress over buying the dip or timing the market just right. You can just invest and live your life. Second, they're cheap. Index funds have really low fees. Like we're talking 0.03% in some cases. That means if you invest $10,000, your annual fee might be only $3. Compare that with actively managed funds, which often charge 0.5% to 1% or more. Those higher fees eat into your returns, especially over time. Third, diversification. This one's huge. When you buy an index fund, you're not buying one stock, you're buying hundreds, sometimes even thousands. That spreads out your risk. If one company tanks, it doesn't wipe out your portfolio. Think of it like this. If you invest in an S&P 500 index fund, you're buying a tiny slice of Apple, Microsoft, Amazon, Google, and 496 other companies, all in one move. Fourth, long-term performance. Historically, index funds have done very well over the long run, often better than actively managed funds. Why? Because it's hard to beat the market, even for the pros. Most active fund managers underperform their benchmark over time. Index funds just smash the market, and that's been enough to win. And finally, tax efficiency. Since index funds don't do a lot of buying and selling, there's less capital gains tax passed on to you. That makes them especially great for taxable accounts, like your regular brokerage account, not just retirement ones. So if you like low stress, low cost, and consistent results, index funds might be your best friend. But here's the thing, no investment is perfect. Index funds are great for a lot of people, but they're not a magic solution. So now let's flip the coin and talk about the downsides of index fund investing, because there are some things you need to watch out for. Part 5, cons of index funds. First off, index funds can't beat the market. They're designed to match the market, not beat it. So if you're dreaming of outperforming the S&P 500 every year, index funds won't do that for you. Next, there's no flexibility. Since index funds track a set group of companies, you're stuck owning all of them, even the ones that might be struggling or overvalued. You can't just sell off the bad apples. Then there's something called tracking error. That's the small difference between how the index performs and how your fund performs. Usually, it's tiny, like 0.01%, but over time, those little differences can add up. Finally, most index funds are market cap weighted. That means the biggest companies have the most influence on your fund's returns. So if Apple or Microsoft makes up 7% of the index and they tank, your fund will take a hit. That's the trade-off of index investing. Broad exposure, but some concentration risk. So yes, there are some downsides. But before you decide, let's quickly clear up one more thing. The difference between index funds and ETFs, because that's where a lot of beginners get confused. Part 6, index funds versus ETFs. At their core, both index funds and ETFs are passive investments that track a market index, so they have a lot in common. But here's the key difference. ETFs trade like stocks. That means you can buy and sell them anytime during the trading day at market prices. Index mutual funds, on the other hand, only trade once per day at the market's closing price. Another important difference is tax efficiency. ETFs tend to be more tax-friendly, especially if you're investing in a taxable brokerage account. That's because when you sell ETF shares, you're usually selling them directly to another investor, which means fewer capital gains taxes passed on to you. With mutual fund index funds, the fund manager might sell underlying assets, which can create taxable events for all shareholders. So if you're investing inside a tax-advantaged retirement account like an IRA or 401k, this difference usually doesn't matter much. But if you're investing in a taxable account, ETFs might give you a slight edge. All right, now that you know the difference, let's talk about how to actually get started investing in index funds and make it easy to put your money to work. Part 7, how to start investing in index funds. All right, so now that you know what index funds are and why they're so popular, let me show you how to actually get started investing in them. It's simpler than you might think. Step 1, open a brokerage account. This is just an online platform where you buy and sell investments. Some of the most popular ones are Fidelity, Vanguard, and Charles Schwab. They all have user-friendly websites and apps. Step 2, fund your account. You'll link your bank account and transfer money over. This usually takes a few days, but once your money is in, you're ready to buy. Step 3, choose an index to track. The most common is the S&P 500, which covers 500 of the biggest US companies. But you can also pick the total stock market index, the NASDAQ composite, or even bond indexes, depending on your goals. Step 4, buy your index fund. You can pick either a mutual fund or an ETF that tracks the index you chose. The great news? Many index funds have no minimum investment, so you can start with as little as $10. So there you have it. Opening your account, funding it, picking your index, and buying your fund. Easy, right? Now, you might be wondering, how many index funds should I actually own? Should you just pick one, or do you need a bunch? Let's dive into that next. Part 8, how many index funds do you need? For most people, 1 or 2 well-diversified index funds are more than enough to build a solid portfolio. You don't need to overcomplicate it. For example, the VFIX, which tracks the S&P 500, covering 500 of the largest U.S. companies. The VTSX, or Total U.S. Stock Market Index Fund, which gives you exposure to almost the entire U.S. stock market. If you want international exposure, you can add something like VXUs, which covers markets outside the U.S. And to balance out risk, many investors include a bond index fund like FTBFX to add some stability. Now, if you're interested in specific sectors like technology or emerging markets, you can use more targeted index funds. But keep in mind, the more targeted funds you add, the more you'll need to watch your overall diversification and balance. All right, now that you know how to build a simple yet effective index fund portfolio, let's get real for a second. Are index funds really the right choice for you? Part 9, real talk. Should you use index funds? All right, now if you're aiming to beat the market, become the next Warren Buffett, and pick all the winning stocks, Index funds probably aren't the right fit. By design, they mash the market, not beat it. But here's the truth. For most people, index funds are a simple, stress-free, and low-cost way to grow your money over time. They give you solid returns without the headaches of researching stocks or timing the market. And here's a little insider tip. You don't have to choose just one or the other. You can combine the best of both worlds. Put, say, 90% of your portfolio in broad index funds for steady growth, and then use the remaining 10% to buy individual stocks you believe in, like Tesla, Microsoft, or any company you want to follow closely. That way, you get diversification and stability, plus a little fun and potential upside from your personal picks. Now, before we wrap up, let me answer some of the most common questions people ask about index funds. Quick and straight to the point. Part 10, FAQs. Quick answers. All right, are index funds popular? Absolutely. Today, about half of all fund assets in the US are invested in passive index funds. They've become the go-to choice for millions of investors. Do I need a lot of money to get started? Nope. Many index funds have no minimum investment requirement, so you can start with just a few dollars. Are index funds safe? They're generally safer than buying individual stocks because they spread your money across hundreds of companies. But remember, safer doesn't mean risk-free. If the overall market drops, your fund will too. Can I lose money investing in index funds? Yes, the value of your investment can go down if the market goes down. But over the long term, index funds have historically trended upward. Now that you have a better idea of what index funds are and how they work, let's wrap things up. Index funds might not be the flashiest or most exciting way to invest, but here's the truth. They work. They're simple, smart, and low cost, making them one of the best tools for growing your wealth over time. If you're serious about building your financial future without the stress of picking individual stocks, index funds are a fantastic place to start. If you found this video helpful, please hit that like button to let me know. Got a favorite index fund or any questions? Drop a comment below. I love hearing from you. And don't forget to subscribe for more practical investing tips every week. Thanks for watching, and I'll see you in the next video.